In this episode, we chat with Peter Christodoulo, a partner at Francisco Partners, which is a leading global investment firm that specializes in partnering with technology and technology-enabled businesses. Peter joined the firm in 2008 and focuses on investments in the financial technology and application software sectors. He currently serves on the board of directors of Allston Trading, Dynamo, NMI, Paradigm, PayScale, SourceScrub, TS Imagine, and Verifone, and is also involved in FP's investments in Betterment, GAINSystems, NextCapital, Prosper Marketplace, and Renaissance. We chat about how he approaches his relationship with each company he invests in, the value he and the firm bring to management teams, and FP's commitment to ESG, among other topics. We hope you enjoy the show. So Peter, thank you so much for taking the time to chat with us. It's a delight to be with you. I'd actually like to start off this conversation with a quote. The word partner connotates the basic thought of working shoulder to shoulder, driving towards a common goal. Not only does Francisco Partners epitomize that concept, but I believe Peter developed it within the company. I am proud to say he is a great partner for me, along with many within the Verifone team, as he works tirelessly driving solutions which benefit all parties involved. He is an icon within the fintech space and always seems to not only know what is happening, but is typically in the middle of it, which only makes my job easier as CEO. It has been an honor working with him. This quote was provided by Mike Pulley, CEO of Verifone. I wanted to start there because I think it's rare and unique that an investor would receive such praise, from a CEO they had invested in. Can you tell us about how you approach your relationship with each company that you invest in?
Absolutely. And thanks for having me today, RJ. I really appreciate it. So what I would say is I try to morph into what they need me to be. And in different situations require different solutions. I'd say sometimes it's a company that's working great and we're trying to, go from good to great or great to excellent, or we're trying to accelerate or do M&A or provide sort of advice, just straight up advice on how to do things for maybe younger CEOs. In the case of Mike Pulley, we were rebooting a company. The company was a legacy company that needed to be rebooted, and we worked with him shoulder to shoulder for the 6 months ahead of closing to really get him to pre-pack as much as possible so that he could, on day one, really go start driving change in a company. And that was, I think a lot of the quote he just said was around that, because we tried to arm him with everything he needed to kind of hit the ground running and not take 6 to 12 months to kind of ramp up organically. Now, obviously that happens too. We were there in the trenches with him, both prior to him taking the seat, but also going forward, as things develop. And we've had some, COVID and supply chain and things like that have not been easy to always maneuver, but we're there with him trying to figure out exactly how we can support not just Mike at Verifone, but all of our CEOs.
Mm-hmm. And I like to ask about how investors provide value to the companies they invest in beyond just the capital. We like to think of growth-oriented investors as those that have capabilities they can extend, to the CEOs and management teams they invest in. And maybe we do this within the context of some of the, recent deals you've done, or you could draw on, maybe better examples, but you had a very productive 2021. I'll rattle off a handful: TS Imagine, Dynamo Software, NMI, Betterment, SourceScrub, Paradigm. Maybe you pick and tell us about how you kind of look at some of these companies and kind of what you're doing to help them out.
Yeah, absolutely. Well, I would say we are really involved investors. And what I mean by that is we actually are trying to help our companies transform from one thing to another. And I think what we always start at the beginning of an investment, sort of saying like, okay, here's where we are now. What do we want this to look like in 3 or 4 years? And let's define that in as many ways as we can, or as clearly as we can. And then let's talk about what you need to kind of get there. And so oftentimes that's a lot of different levers. There's a sort of a menu of options on how to do that, but it's not always the same ones employed in each situation. So I would say, oftentimes there's M&A involved. Sometimes there's some managerial change. Maybe it's not wholesale change, but some change. Sometimes it involves a strategy shift. Maybe it's towards more growth, or maybe it's towards more profits, or maybe it's taking the company to Europe or other places. So I'd say sometimes it's just a straight like, hey, what worked from 0 to 50 of revenue isn't going to work from 50. We want to go from 50 to 200. So we probably need to upgrade some things, or maybe we need to take some roles and divide them up, because your CTO probably shouldn't be your head of product and your head of IT and you're the person running the SaaS, the platform on a day-to-day basis, or the NOC. So we're constantly kind of looking at all those things and saying, like, how can we help our company scale? And so I think the one thing that sort of flows through all those situations is evolution. I mean, in order for companies to become better, they need to change. And so you need to be not afraid to hit those issues right on their face and right up front. We try very hard not to be passive aggressive or unclear or whatever, even if it's uncomfortable. It's like, even if it's an uncomfortable conversation right up front, we'd rather have that. And then the person's like, they think about it, or they say like, okay, right, we actually probably should split my job into two jobs, because when this company's twice as big, like, I can't do both these things. And so we often have those, and sometimes it's a little awkward up front, but I think everyone appreciates it and knows that we're trying to grow the companies. We're trying to grow them organically and organically, make them more profitable, maybe by design less profitable if we want to do things differently. But I'd say we're always trying to pull all those levers. And I think our operating team also really helps us in those regards, because sometimes they can talk with our companies in a way that investors can't, because they can say, hey, look, we are, I was a head of sales and marketing, and or if our operating team, they can go into a company and say, hey, like, we were in your shoes, and let me tell you what's going to happen in 2 years if we don't make some changes now, because this machine's going to break if we don't prep it for scale.
And it seems like you sit on a lot of boards, and I was kind of curious how you kind of manage your involvement, with each of the companies. And so is it that you do have an operating team involved with each of the companies, and you're kind of coordinating while still serving as kind of counsel to the CEO? How does it work? How do you kind of manage and allocate your time?
It's a very good question. That's tricky, but we try to, we work a lot, but that's our job. But I'd say typically the first year of an investment is more involved. And it's because we did just all the stuff I just talked about. We try to define where they want to go. What do they need to get there? We might need to take a half step back to take 2 steps forward, or break some things down to build them back up. And so usually that first year, maybe year and a half, 2 years, can be much more involved, not just from me, but from our ops team. And I'd say we really push our companies. Like, let's really talk about what we want this to be, and let's prep now for what we want it to be, then, or let's figure out what we need to do and go do it. And so I'd say usually after like year 2, if things go to plan, typically we're more on cruise control, and it's okay, like this machine's humming, and let's just let it hum. Now, sometimes it takes less time, sometimes it takes more time, sometimes you get thrown a curveball. But I'd say the way a lot of the investments, and this is also why we stayed in Dynamo Software and we stayed in NMI, 2 of the deals last year that we are now joint control with another sponsor in both those, because they're working great. They grow really nicely. They make money. They have M&A opportunities, and they actually won't be that much of my time going forward because the machine's humming. And so that's great. And but look, time management is like the number one issue.
Capital in the private markets now is plentiful, and there's more firms starting. There's firms that are raising bigger and bigger funds, and so some may view capital as a commodity. You're very productive. You're able to do a lot of good deals. And so what do you think it is that's enabled you to be as productive as you are, and to be able to kind of, showcase to the companies why you're, the ideal partner?
Well, I appreciate those kind words. I would say we try really to block out all the noise. The market is enormous in fintech or in software. Very dynamic, lots of stuff's going on. You could spend all day just reading headlines of things that are happening in the sectors. And we really try not to do that. We do that a little bit, obviously, because you sort of have to, but we really try to think about like where are good opportunities for us. And what I mean by that is what are situations where we can go to a company or approach a company and say, look, we are your ideal partner, and here's what we'd like to try to do. We think we could do with you. Here's our experience. Here's our credibility in doing things that look like this. Here's our plan. Here's the advisors or experts that we could bring to bear. And so we try not to just fall into looking at every company that's for sale or every company that's out there looking for capital. Instead, we try to do the opposite and say, like, what companies do we want to go pursue? What companies do we want to try to go provide capital to? And then go make a very targeted approaches to them. I think a lot of our best deals have had those attributes. If the first time you're finding out about a company or even learning the name of a company is when Goldman Sachs is selling it, they're calling up 50 of our best friends to look at it too. Like, that's probably not a great opportunity for us. Even if we are really well situated, well, if we're really well situated, we would have known the company already. And if we really were well positioned, then we would have been 6 or 12 months ahead of that in some way. So I would just say we try to block out the noise, really think about it the opposite way and say, where do we have a right to win? Where are we unfairly advantaged relative to everyone else? And I don't mean that just in terms of a deal dynamics or getting deals done, but like, where can we really help like we see a company, we say, we can make this 3 times bigger and we know exactly how to go do that. So let's go approach them.
The other thing we like to look at with firms is how they're doing on the ESG front. There's no kind of hard and fast rule on what makes a firm great at ESG and what makes a firm, bad at ESG. But can you tell us what, Francisco Partners has been doing on that front?
Absolutely. And it's always been an enormous issue, but I think it's even more so a topic that we take super seriously at Francisco Partners. All of our companies, before we invest in them, go through ESG audits. We look at the entirety of, ESG is a lot of different perspectives. It's not, it obviously covers a lot of things, but it's both soft and hard things as well. And I think some of our companies, where there is a social good or there is a positive, social societal benefit, we rank that highly also. Some of our companies are providing services to people that, maybe didn't exist before. So obviously there's environmental and there's all the pieces to ESG on governance and compliance and whatnot. But there's also, different, if our products in our education software companies are helping students learn better, like, that's great. We have a company, Betterment, that's helping people manage their finances and money better. And sure, it's we want to make money on our investment, but 725,000 people, get great financial advice from Betterment. And that's really gratifying also. So I think it's, yes, we do the sort of formal, ESG kind of analysis and audits and make sure that we're up to snuff there. But then we also look at these other things and say, hey, look, is this a company I'm proud of investing in, that I want to tell my family about, that I feel like everyone will be proud that we're associated with.
And is there typically job growth kind of post-investment in a company? How do you, this may vary kind of depending on the given situation, investment situation, but do you typically see job growth in the companies you invest in?
Absolutely, for sure. Maybe there's some situations where that isn't the case, where we have maybe a legacy company that needs to have some rationalization in order to survive and then grow off of a new base. But I'd say in 90+% of the situations, it's job growth from day one and it's investing for growth. I mean, in technology, yeah, we like profits too. Okay, who doesn't? But the way we get paid, the way that we're not altruists, right? The way we get paid is through growth, and that's not just growth in revenue, but that's growth in jobs, that's growth in opportunity. And I'd say one of the things we really like to do is give those sort of younger people or mid-level people in a company opportunities to go step up. And that's part of what I was saying about before. Maybe you split someone's job, or you give, when you give someone who's 30, the opportunity to go run a business group or something, it's incredibly powerful. And they will go at that super hard if they are given a differentiated opportunity and they really value it. So you find the right talent and you empower them. It's really great. So it's funny. We're always looking through the windshield, not in the rearview mirror. It's not kind of what you have done. It's what are you going to do, and how do we empower you to go do that and make you care a lot about it, because we care a lot about it.
And a couple more questions as we kind of round out our chat here. And these may be leaning more towards the personal side, but could you tell us about a time you found particularly challenging as an investor and how you were able to get through it?
For sure. There's lots of examples. It's not, it can be a stressful job. One company where we invested and the first 6 months were, I would say, horrible. And they're horrible for one really clear reason, which is the CEO of the company, it had been his fourth exit of different types, not all private equity, but he had his fourth exit. He had made a lot of money and he just stopped working. And what was really troubling for me is that the first bullet in my investment memo was strong leader. This is a guy we want to work with. He's a superstar. And he had been a superstar 4 times over, but he just started mailing it in after our deal. And he kind of, I think for a lot of reasons, he didn't tell us that. His body, like he had sort of had cognitive dissonance or something where his body and his mouth or brain were saying different things. And he just wasn't, his heart wasn't in it. He wasn't working hard at all. He was showing up at the office maybe one day a week, we found out. And the company just started sort of disintegrating over the first 6 months of our investment. And it was incredibly embarrassing for me because I pounded the table with my partners to go do this deal, really to invest behind this guy, among other things. And then I'm finding myself 6 months into investment, having to get on a plane and fire the guy. And it was incredibly uncomfortable for me, for him. We just written a multi-$100 million check into this company. And he had taken a bunch of money off the table. And so it was just very, very awkward and I'm taking a lot of heat internally, we've got other people around the situation it's tough when that's the circumstance. But we had the courage, I think partly because of our operating team, Francisco Partners Consulting, to help us get around the situation, really understand what's going on. We started hearing these anecdotes that were really bad. And we decided to go make a change. And maybe 10 years ago, I wouldn't have had the courage to go do that without our operating team being so involved. We probably would have let it go for another 6 months. We saw a lot of stuff we didn't like. The company's performance started eroding quickly. We started seeing some exits from the company and we went and made a change. And I'm really glad we did. I think after that, things got a lot better. And the investments actually turned out to be a very good one. But I'd say that first 6-9 months was harrowing. And it's no fun to have to go fire someone or have to go make a change like that. But it's especially not a lot of fun when you've hung your investment thesis on backing the guy. So.
Mm-hmm. Was there any sentiment of, because it sounds like it was quite a while ago when you were much younger, maybe in your earlier years. So was there any sentiment of, well, you're a young investor, you may not be, making the decision based on experience?
Yes. Yes, there was a lot of questioning going on, but you're not really tested when things go well. You're tested when you have a situation like that. And it's when you're an investor like I am, and all my peers, I'm sure, would say the same thing, which is you're going to have situations come up. Things are not going to always go well. You're going to have executives or markets or companies do things you don't like them to do or don't want them to do. The question is not, are those things going to happen? The question is, how do you react to them? And when the heat gets turned up, what do you do about it? And that is really, I think, the question. And so, that was that. And I was a younger investor, and that was one of the, I think it was the third deal I'd led or something. And yeah, it was really stressful. My wife telling me, like, "What's wrong, Peter? Like, you seem really upset." I'm like, "Yeah, I'm upset." Like.
Let's end on a maybe less stressful note. Hopefully we didn't raise your cortisol by recalling that situation, but it sounds like it ended up well. So overall, it was a good learning. Could you tell us about a book that you read that had a profound impact on you? A book recommendation, essentially.
Okay. It's embarrassing to say, but I don't read as many books as I should these days. And it's been a while since I've been reading at a clip that I'd like to. But I would say there's a bunch of books that I've liked at different times. I'd say one of the books that I think is the most interesting is there's a book by Ernest May called Strange Victory. And it's a history book. It's nothing to do with investing or software or fintech or anything, but I think it's a really interesting thing to read. And it's about the beginnings of the war in Europe in World War II and how the common narrative is that Germany just ran over France and France was ill prepared and blah, blah, blah. But the actual reality wasn't that at all. France was very well prepared. And there's a whole series of things that happened that allowed Germany to take over France. Common narrative is actually not right at all, and how really a series of missteps and a series of sort of unfortunate events allowed that to happen. The reason I raise it is because it's sort of like the don't judge a book by its cover. Don't judge a situation by the kind of common narrative. And it's something I use in investing now a lot. Is sometimes situations will come up and it'll be like, hey, this company's maybe they want to do something, and if you go with the common narrative, sometimes you miss things. Sometimes you miss great opportunities, or you don't see them because everyone's chirping in the market about something, but that might not be right. That might not be the reality. And it rarely is as good as people think or as bad as people think. Sometimes there's more nuance to it. And so I think that's a book. It's like a 700-page book. It'll take, I read it in like 2 days because I was so engrossed by it. But I think it's a study in kind of not taking things for granted. And sometimes the best investments are when you go look at something that everyone else has said no to, because maybe they are all thinking about that common narrative.
Well, that's a good note and insight to end on. So, Peter, I want to thank you again for taking the time. I know our audience will find this very insightful. Well, thanks so much for having me, RJ. This has been a pleasure, and I really appreciate it. And hopefully this is helpful.